Hey everybody. So today I want to talk about legal entities, business formation, and what the implications are from, say, forming a sole proprietorship versus a C-corp, S-corp, LLC, that sort of stuff. So we'll start off with sole proprietorship. So sole proprietorship is basically a one owner company, and they have not incorporated, right? So they have no liability protection, meaning if they get sued, the person suing them can come after their personal assets, their house, their cars, whatever, their retirement accounts. Whereas, and so that sole proprietor would, for taxes, would simply file a Schedule C, profit or loss from business. And that schedule just has you put your gross receipts and then list out all of your expenses and arrive at a profit. And then that's what you get taxed for federal income tax purposes. And then you also take that number over to your Schedule SE for self-employment tax. And you use that number to calculate what you owe for that. And that's 15.3% of 90% of that profit or loss number. So of the profit, not the loss. And so what SE tax is basically both sides of FICA, the employer and the employee portion of Social Security and Medicare tax. And as a self-employed person, you pay both halves. You pay the employer and employee. Okay, so if you are an LLC, so let's say you realize I'm getting too big to bear the risk of being sued, and so I'm gonna incorporate. So you file your articles of incorporation with whatever state, and at that time you can choose to be an LLC or a C-corp or a partnership. But let's say you choose to be an LLC, and again, you wholly own this business, just you. So it's a single member LLC, and that gives you limited liability protection. So they can't come after your personal assets, they can only come after the business's assets, okay? The IRS will disregard you as a separate entity by default, meaning if you don't make any other elections, and I'll get to that in a minute, you will still just file your Schedule C and your Schedule SE as a sole proprietor, because you are a single owner of this company. But you can elect to be either a C-corp or an S-corp for tax purposes. Now, I'll get to C-corp in a minute, but S-corp allows you to pass through your taxes, and a C-corp gets taxed twice. And again, I'll cover those in a minute. So that's your single member LLC. If instead you take on another business partner or another shareholder or LLC member, you then become a multi-member LLC or a partnership. This is when you have two or more owners, and now you're going to file a different form with the IRS. So remember, if you're a disregarded LLC, single member LLC, you're just going to file that Schedule C, Schedule SE. If instead you elect to be a C-corp, it would be an 1120. That's a separate tax form. You got to pay a CPA to prepare that for you. If you elect S chapter status, make that S election. Now you're an S corp, and you're gonna be filing an 1120S. By the way, S corp is just an IRS distinction. It's not a legal entity that you incorporate as. Like I said up front, you're going to incorporate as a C-corp or a partnership or an LLC You're not going to incorporate it as an S-Corp. That is a IRS distinction only. You file a form with them and you make that election. And I'll get to that next. But so with your multi-member LLC, you're going to file, generally, unless you make the S chapter election, you're going to file a 1065, which is a partnership tax return. Okay. Now, let's talk about what pass-through means. So partnerships, 1065, and S-Corps, 1120S, are pass-through entities. What that means is the corporation doesn't pay tax itself. Instead, it passes that taxable income onto its shareholders or the partners if you're a partnership. And so you get something called a Schedule K-1, and that gives you your share of income. So let's go back to our example. You took on a business partner, you're 50-50. 50% ownership, 50% share of the profit, 50% share of the liabilities, etc. So when you make your money and it comes time for taxes, your accountant is going to prepare a Schedule K-1 that gives you 50% of the profit on that K-1, and you're going to attach that to your 1040. And instead of filling out a Schedule C, Schedule SE, you're going to fill out, that information is going to flow from your K-1 to your 1040. You're going to pay federal income tax on it. And you're only going to pay self-employment tax on the portion that you took as a salary. And that's the benefit of incorporating as a S-Corp or an LLC. Incorporating as an LLC and getting the tax treatment of an S-Corp is what I meant to say. That pass-through allows you to only pay income taxes on your share of the income, but also it limits how much employment tax, FICA and your FICA tax, your Medicare and your Social Security, you only pay that on whatever salary you take. So if your business gets pretty big, you're making over, let's say you own it by yourself and you're making over $100,000 a year, you should think about electing S chapter status, or electing to be taxed as a 1065 partnership, so that you can then draw a salary and pay your payroll taxes only on that salary, your employment taxes, your FICA. And then the rest of the money that you make, you'll pay federal income tax on it, but you won't pay employment tax on it. And because it's a pass-through entity, you're only taxed one time. Now, a C-corp, you get taxed twice. You get taxed when the business makes the money. You file that 1120, and the corporation pays a flat 21% tax rate on that income. But when you decide you want to take money out of the business as a dividend, you get taxed again at your personal rate. That's where it sort of is like that pass-through tax that we talked about with the S-Corp and the LLC that's treated as an S-Corp or as a partnership. You're when you get taxed on the dividend, though, it's taxed at your personal income rate. It's taxed at the rate that's determined by your personal situation. So, if the CEO is making millions of dollars a year, and they get that dividend, it's going to be a different story for them in their tax situation than it would be for, let's say, someone further down the line in the company that is making far less money, and they get a dividend. And there's a bunch of rules around it. There's qualified dividends that, depending on your taxable income, you may not pay any tax at all on a qualified dividend. But I'm not going to get into all that. I'm just covering basics here. So again, your C-corp, there's double taxed at the corporate rate of 21% flat rate, and then you're taxed again on the dividend. For that S-corp election, which is again, either an LLC or a C-corp that is made the election to be treated as an S-corp for tax purposes, as well as the partnership, they are only getting taxed one time, and so they're on all of the income, whether or not they took it out of the company or not. So, if you're like a new company and you start up and you want to keep the money in the business so you can grow, you want to buy, more assets, more equipment to keep expanding your enterprise, money that you haven't spent yet, that you can't write off against your gross revenue, whatever profits you have that you plan to reinvest, you still get taxed on those, right? You get taxed on them, even though you didn't take that money out and spend it personally, you still got to pay tax. So what a lot of shareholders do, or LLC members or partners do, is they take out a distribution that's tax-free, and they use that distribution to pay their taxes. So it's kind of a weird situation you're in, with having to pay tax on money that you didn't actually withdraw from your company to spend it on personal expenditures. So let's see, what else? So there are other differences between a C-corp and an S-corp is, with an S-corp, you're limited to 100 shareholders, 100 shareholders. With a C-corp, it's unlimited. Like Apple, Microsoft, Intel, Ford. There's no limit on how many shareholders they can have, right? They're C-corps, and so they don't have any limit, and they can trade their stock then on the stock exchange. By the way, that flat rate on the C-corp of 21%, that's relatively new. That came about as part of the Tax Cuts and Jobs Act of 2017 during Donald Trump's first term in office. Before that, it used to be a graduated tax rate where there were brackets like there are for the individual taxes, 15, 25, 34, and 35%. And so, under the old system, if you only had a small amount of income, of profit from your C-corp, you only paid 15%. And now under the current rules, those small businesses that would otherwise be in the 15% bracket are now paying the 21% flat tax amount. So it's not so good for the small business. It's better for the bigger corporations that otherwise would be paying, 25, 34, and 35%. They're now getting a tax break and only paying 21%, which then gets passed on to the shareholders. And people complain about, the corporations don't pay their fair share, and they da da da. And it's like, well, if any of you have a 401k, guess what? You're a shareholder. You might want to rethink how much you want to penalize corporations, because that benefits all of us. When corporations make money, those of us that have mutual funds and 401ks and pension plans, we want these companies to make money. It's good for the economy. It's good for people that are working that want a retirement someday. Okay, so just my 2 cents on that. All right, so there's other things to consider. I'm going to keep this short, though. I'm already at 14 minutes. If you've got questions or comments, please put them down in the comments section. If you like this video, please smash the subscribe and like buttons and follow me. And do appreciate that. And I will talk to you later. Thank you.